Welcome to the Deep Dive. We're here to cut through the noise and get you well-informed, fast. Today, we are putting a major e-commerce player, Eternal Ltd., you probably know them as Zomato, under the microscope. Their Q1 FY26 performance has definitely been creating some buzz, and for good reason.
That's right. It's a really interesting one. For this deep dive, we've waded through two detailed analyst reports. One's from Securities, the other from Dolat Capital. And we've also got Zomato's official performance briefing right here.
So our mission today is basically to sift through all that, pull out the key insights, and help you understand what's really going on, especially how these different experts are, reading the very same numbers quite differently.
Exactly. You should walk away with a much clearer picture, really understanding the nuances behind what looks like, well, a pretty complex earnings report.
Okay, let's get into it then. The headline for Zomato's Q1 FY26. I think you summed it up before we started. It's really a mixed bag.
A mixed bag is the perfect description. On the one hand, you've got consolidated revenue. That was a clear beat. It soared a huge 70% year over year, and 23% just quarter over quarter. Came in at over 7,000 crore, about 71.7 billion rupees.
70% year on year, wow. And that beat was driven by...
Well, both reports really point to the same thing. Better than expected performance from Blinkit, that's their quick commerce arm, and also Hyperpure.
Okay, so top line looks strong, but, and this is where it gets really interesting, maybe a bit confusing. Despite that great revenue growth, profitability actually missed expectations. Quite badly, it seems.
Yeah, that's the twist. Take the EBIT margin. It came in at just 1.6%. That's down 260 basis points compared to last year.
1.6%. Why the drop? Are the analysts agreeing on that?
Sort of. Securities puts it down to higher operating costs, mainly from, all that rapid store expansion. Makes sense. But Dolat Capital flags something different. They attribute it more to higher losses in the going out and others business. So slightly different angles there.
Interesting. Different culprits highlighted. And this profitability issue, it really hits the bottom line, right? The net profit.
Oh, absolutely. The net profit, or PAT, it didn't just dip, it plummeted. We're talking a staggering 90% drop year over year. It landed at only 25 crore rupees, or 250 million. That was a huge miss compared to estimates.
90%, wow.
And Dolat Capital adds another layer there, pointing out that a higher ETR, that's the effective tax rate, further extended the earnings miss. So taxes played a part too.
Okay, and what about operating profit, EBIT?
That picture isn't pretty either. The company reported an operating loss of 199 crore rupees. And that loss worsened by, get this, 810.7% compared to last year.
Over 800% worsening. So what's the takeaway here? What does this setup tell us?
It really sets up this core tension, doesn't it? You've got growth that's undeniably strong, almost explosive in some segments. But profitability is clearly under, immense pressure. It's that classic growth versus profit dilemma playing out right now.
Trying to grow super fast, but it's costing a lot. Like building that fast car, but ignoring the fuel gauge.
That's a good way to put it. They're expanding the footprint, boosting the top line, but the cost of doing that is really eating into the bottom line.
Right. So we need to dive into the segments. That's where we'll see where the growth is and maybe where those costs are really piling up. Let's start with quick commerce Blinkit. You said it's the growth engine, but with a catch.
Definitely the growth engine right now. Blinkit delivered, explosive growth is the only word. Its net order value, the NOV, that's the value after cancellations and returns, it grew an incredible 127% year over year.
127%?
Yeah, and 25% quarter over quarter, hit over 20,000 crore rupees. And look at the customers. Monthly transacting customers surged 123% year over year. Jumped from 7.6 million to nearly 17 million.
Huge customer growth and revenue.
Blinkit's revenue on its own also grew significantly, 40% quarter over quarter, reaching 24 billion rupees.
Okay, and they're not tapping the brakes on expansion, are they?
Not at all. They added 243 new stores just this quarter. Total's now 1,544, and they're sticking to that ambitious target. 2,000 stores by December 2025, and they're even talking about 3,000 stores after that.
Wow, aggressive. But here's what strikes me as, maybe counterintuitive. Despite all that spending on expansion, Blinkit's losses actually narrowed. You mentioned negative 1.5% of GOV. Adjusted EBITDA margin improved a bit too. How?
Yeah, from negative 1.9% to negative 1.4% on adjusted EBITDA. It's a really critical question, and the answer seems to lie in a game-changing strategic shift. They're moving to what they call an inventory ownership capital control model, IOCC for short.
IOCC. Okay, what does that mean in practice?
It means Blinkit is moving away from being just a marketplace connecting buyers buyers and sellers. Over the next, say, 2 to 3 quarters, they're transitioning to actually owning the inventory themselves.
So they hold the stock. That is
Yeah.
a big change. What's the rationale?
Management is betting this gives them more leverage on margins. That's the key phrase. It should also let them, and I quote, push harder and faster assortment expansion. They're projecting maybe a 100 basis point margin expansion over time from this.
1% potential margin gain.
Exactly. And they're even guiding for a pretty impressive 40% return on capital employed, assuming they hit a 5-6% adjusted EBITDA margin eventually.
So this IOCC thing, it's not just moving numbers around on a spreadsheet. It's a fundamental shift in strategy. Betting on control, maybe over flexibility.
Precisely. But there's a trade-off, and it's crucial for, for you listening to understand this.
Okay, what's the trade-off?
Well, on paper, quick commerce revenue will look higher. It'll become very similar to NOV and increase. But, and it's a big but, the net working capital needed is going to jump significantly.
How much are we talking?
They expect it to go from about 1% of NOV currently to about 5% of NOV. That's like a 5-fold increase. It basically means tying up cash and about 18 days worth of inventory.
Right, holding stock costs money.
And that's not all. It also requires cumulative capital spending, CapEx, of around 4% of NOV just for the store infrastructure needed to support this model. So, bottom line, they estimate total capital employed will be around 9% of NOV. They're sinking a lot more cash up front.
More cash tied up for those future promised returns.
Right.
This is where Dolat Capital gets skeptical, right? They use the word Mirage.
Yeah, that was their take. They said, shift in model Mirage, lowered QC losses, overall pain remains.
What exactly do they mean by Mirage there? Are they saying the improvement isn't real?
They're not just being dramatic. Their point is they believe a chunk of this reported loss reduction isn't from fundamental business improvement. They think it's more down to this accounting change and the model shift itself. They argue that the underlying issue, fierce competition in quick commerce, hasn't gone away. That's the headwind limiting a meaningful turnaround in overall profitability.
Okay. So the numbers might look better on one line item because of the model change, but the actual cash burn and competitive pressure might still be just as intense.
Exactly. It's a really important distinction when you're trying to gauge the true health of the business. Are the economics improving or just the way they're reported?
That's a key point for anyone tracking Zomato. Okay, let's shift gears. Food delivery. You said it's sort of bottoming out, but growth is slow.
Yeah, much more modest growth here compared to Blinkit. Net order value for food delivery grew 13% year over year, 9.2% quarter over quarter, reached 90 billion rupees. The company puts this down to subdued consumer sentiment.
Subdued consumer sentiment. What does that really mean here? People ordering less.
Probably a mix of things. Could be wider economic pressures, people cutting back a bit, or maybe the market's just maturing after that huge pandemic boost. Perhaps hitting saturation in some cities.
Makes sense, but management sounds optimistic.
They do. They believe growth has bottomed out. They're expecting demand to pick up, projecting 15% growth for FY26, maybe 20% in FY27. Interestingly, they see this coming mostly from adding new users, not necessarily people ordering much more often.
Okay, and margins dip slightly here too.
Just slightly. Food delivery contribution margin went to 8.2% from 8.6%. Adjusted EBITDA margin dipped a bit too, 4.2% from 4.4%. They blame mostly seasonal things, summer heat, monsoon rains affecting demand or operations, and maybe some rider availability issues.
Right, and they've got new leadership there too, Mr. Aditya Mangla.
Yes, appointed as the new CEO for food delivery. They mention it's part of a rotational CEO method they use for more mature parts of the business, trying to, build leadership depth.
Okay. Let's turn to Hyperpure now. That's their B2B supplies business.
Correct. Hyperpure actually showed strong growth recently. Revenue up almost 25% quarter over quarter, nearly 90% year over year. Hit 22.9 billion rupees. Losses narrowed a little bit too, down to 180 million rupees.
Sounds positive, but there's a catch here too, linked to Blinkit's change.
Yes, this is the key thing for Hyperpure. Its reported revenue is expected to basically get halved on a run rate basis in the coming quarters.
Halved. Why is it bad?
Not necessarily bad. It's a planned shift. It's a direct result of Blinkit moving to own its inventory via the IOCC model. Stuff like fresh foods, staples, things Hyperpure used to supply to non-restaurant partners. That's now moving under Blinkit's direct control. So Hyperpure will become much more focused purely on supplying restaurants.
Got it. So it's a strategic refocusing, reflecting the numbers. Okay, finally, the going out and others segments. You call these an investment sink.
Well, they're certainly costing money right now. The going out segment, things like dining out deals maybe, saw revenue dip 9.6% quarter over quarter. They blame seasonal weakness. And its adjusted EBITDA loss actually got bigger, reaching 540 million rupees.
Despite that, management is still bullish. Talk about $3 billion potential.
Very bullish. They project 30% year-over-year NOV growth for going out and see a path to, $3 billion annual top line with $150 million in adjusted EBITDA. But that's over 5 years. It's a long-term bet.
A very long-term bet given the current losses and the others segment. That's where the new bets are.
Exactly. This houses the really new stuff, like Nugget, their AI platform, and Bistro, the 10-minute food delivery pilot. Right now, this segment makes almost no revenue, just 40 million rupees this quarter. But the losses are significant, 450 million rupees.
Wow, 450 million loss on 40 million revenue.
Yep. And Dolat Capital specifically flagged this. They noted that a total of 1,500 million rupees has been budgeted for loss funding across these new initiatives in FY26. That's about 150 crore rupees. So this is a big part of understanding that overall profit miss we discussed earlier. These are expensive experiments right now.
Absolutely. Investing heavily in the future, but it's dragging down current profitability. Okay, so we've unpacked the segments, the revenue beat, the profit miss, the strategic shifts, which brings us back to that really fascinating point, the analyst divide. Same data, but Axis Securities says hold and Dolat Capital says sell. Let's break that down. Axis first.
Right. Axis Securities is maintaining a hold rating. They did nudge up their target price a bit from 230 to 250 rupees per share. At the time of the report, that implied about an 8% potential return from the current market price of around 271. So not huge upside, hence the hold.
And their reasoning for being cautious, despite the growth.
They basically believe the competitive intensity, especially in quick commerce, is likely to cause near-term volatility. So they see the potential, but they're urging a bit of caution given the market fights.
Okay, cautious optimism maybe. Now, Dolat Capital, completely different story. Sell.
Completely different. They're sticking with their sell rating, and they kept their target price unchanged at 170 rupees. Now, compared to the market price then of 272, that implies a potential, a 37% downside. That's a very bearish call.
37% downside. Why are they so negative?
Their reasoning focuses on what they see as potential risks and steep valuations. They're worried the price is too high for the risks involved. They point out their own estimates for FY26 earnings have been more than halved, and they've lowered FY27 estimates too. And they keep coming back to those core concerns. Fierce competition. And their skepticism about the Blinkit model shift that Mirage idea, limiting any real profit turnaround soon.
So they're saying basically it's overvalued given the competition and the fact that some of the apparent improvement might not be as solid as it looks.
That sums up their view pretty well. The valuation doesn't justify the risks and the current lack of profitability, in their opinion.
And that, I think, is the absolute crucial takeaway here for you, the listener. This stark difference in expert opinion. You have the exact same set of numbers, the same company briefing, but analysts arrive at wildly different conclusions and investment recommendations.
It really underscores why you need to look deeper. It comes down to how much weight you give to different factors. How much do you believe the long-term promise of Blinkit's strategy versus the immediate pain of competition? How worried are you about the cash burn from new ventures? And what do you think is a fair valuation?
Different assumptions lead to different outcomes. So wrapping this up, Zomato's Q1 FY26 definitely shows that robust top-line growth, particularly from Blinkit. No question there.
But it's clearly grappling with significant profitability headwinds driven by that aggressive expansion, big bets on new ventures like Nugget and Bistro, and just really intense competition everywhere it operates. It's like a powerful engine, as you said, but it's burning through fuel very, very quickly right now.
And while that strategic pivot in Blinkit, the IOCC model, holds the promise of better margins and maybe a stronger business model down the road, the near-term outlook is still very much pressured by the sheer cost of it all.
Which leads to the core question, doesn't it? What's ultimately going to win out here? Is it the promise of future efficiency and market dominance? Or is it the immediate, very real pain of high investment costs and battling fierce rivals on multiple fronts?
Yeah. And maybe a final thought to leave you with. In today's super-fast digital world, can a company like Zomato realistically dominate multiple huge markets at the same time? Food delivery, quick commerce, dining out? Or is this aggressive multi-front war inevitably going to mean more pain before we see sustained profit? What kind of trade-offs really are acceptable when you're chasing rapid market share like this?
That's the multi-billion-dollar question, isn't it? Food for thought.